Welcome to the deep dive, where we cut through the noise, stack up the source material, and give you the essential truth hiding in the data. Today, we are strapping in for a forensic analysis of one of the most volatile sectors out there right now, consumer cyclical department stores.
Volatile is absolutely the perfect word for it. We're diving into a stack of stock screener reports, and we're looking at some really dramatic price action that was captured on November 25th for three major players.
Yep, that's Dillard's, Kohl's, and Macy's.
Exactly. DDS, KSS, and M. We're talking about some major fundamental shifts happening in, basically real time.
That's right. And our mission today is pretty clear. We're going to treat this raw data like a detailed journalistic report. We'll unpack the fundamentals, the technical momentum, all the key news drivers, and of course the valuation for these three retail giants. The goal is for you to get the shortcut to being instantly well-informed about who's winning and maybe who's struggling in these department store wars.
Yeah, and I think it's crucial that we look past the immediate, the dramatic daily swings, which have been plentiful,
Oh, yeah.
and really examine the core financials and the technical signals. We want to understand not just what happened on the surface, but why the market reacted the way it did based on the numbers right here in this report.
Okay, and just before we jump in, a quick but necessary note. All the calculations and observations we're about to discuss are based purely on the data provided, really just for educational purposes to help you understand sector performance. They absolutely do not constitute investment advice.
Right.
Okay, let's unpack this. We have to start with Kohl's KSS because the performance that's captured in this data is, well, it's nothing short of breathtaking.
Breathtaking is right. The final trading price in the report was $22.42.
Okay.
That reflects an extraordinary daily percentage change of positive 42.53%.
Wow.
That's a gain of almost $6.70 in a single trading session.
Yeah.
I mean, this is high beta volatility personified.
So what's the story here? What's behind that massive swing?
Well, the report points to a few major catalysts. First, their Q3 earnings just blew past analyst estimates.
Okay, that'll do it.
For sure. Then, management raised their fiscal 2025 guidance, and on top of that, the company finally named Michael Bender as the permanent CEO. So, the entire narrative just changed overnight.
And despite that explosion, KSS is still the smallest of the three we're looking at, right? With a market cap of just over $2.5 billion.
Exactly. And that smaller size, combined with all that news, just amplifies the volatility. But here's where it gets interesting. If you just look at the valuation, KSS appears cheap.
How so?
Its PE ratio is 13.15, and its price-to-sales ratio, or PS, is shockingly low at just 0.16.
Okay, let's pause on that PS number. For our listener, what does a PS ratio of 0.16 actually signify?
It's a massive signal of market pessimism. It means the market is currently valuing all of Kohl's annual revenue at less than 16 cents on the dollar.
So investors are basically saying, we don't believe this revenue is sustainable or profitable long-term.
That's it exactly. And that leads us directly into the fundamental red flags that are buried just beneath that low valuation.
And here's where we hit that friction point. We have a cheap valuation, but the profitability metrics are, well, they're paper thin.
Incredibly thin. The profitability is a huge concern. The profit margin is only 1.23%. Return on equity is a pretty weak 5.02%.
Yeah.
But if you want to understand the real risk here, you have to look at liquidity and debt.
Okay.
The quick ratio, which basically measures if a company can meet its short-term bills with its most liquid assets, is extremely low. It's at 0.12.
A quick ratio of 0.12? I mean, that suggests they have almost no cash on hand to deal with immediate problems.
Precisely. And then you pair that with a high debt-to-equity ratio of 1.73.
Yeah.
This means KSS relies far, far more heavily on borrowed money than on its own capital.
So when you're that reliant on debt and you have almost no short-term liquidity, you're just vulnerable to any kind of economic headwind.
You're walking a tightrope. And to make the long-term picture even tougher, the projected earnings per share, the EPS, for the next 5 years is expected to decline by a staggering negative 19.38%.
So we're looking at a stock that's driven by huge short-term excitement, but it's facing some really challenging fundamentals and a negative long-term outlook.
Right. And this brings us to the technical indicators, where that massive price action really becomes clear. The stock is already 4.82% above its previous 52-week high.
It just blew right past it.
Instantly into uncharted territory.
So for short-term traders watching momentum, what does that relative strength index, the RSI 14, tell us? It's sitting at 74.83.
Yeah, that is a classic potential sell, or at least caution signal. A number that high clearly indicates the stock is significantly overbought after that sudden rally. Any short-term trader would see that number and be pretty wary of a sharp pullback.
And we can't ignore that high short float, right? 27.19%. Does that massive single-day move suggest we saw a short squeeze in action?
Oh, it absolutely does.
Mhm.
When nearly a third of the tradable shares are sold short and huge positive news hits, those short sellers have to rush to cover their positions.
They have to buy back shares.
They're forced to buy, which just supercharges the momentum. That 42% move was almost certainly amplified by that forced buying.
Okay, to really visualize this, let's look at it through the lens of a $5,000 hypothetical investment. If you had put that 5 grand in at the previous close of 1573, right before the news hit.
Okay, so $5,000 divided by 1573, you would have picked up 317 shares.
Right. And at the last closing price of 22.42.
The current paper value of those 317 shares is now $7,105.94.
Which gives you a hypothetical profit of over $2,000.
Yeah.
$2,105.94 to be exact. A 42% return in a single day. It just illustrates that extreme risk and reward.
Absolutely. Now let's shift gears to Macy's, ticker M. While it didn't have that same, meme-like frenzy of Kohl's, Macy's still had a very strong day.
Yeah, it closed up over 9% at $21.85, and they're a much larger organization with a market cap of about $5.87 billion.
Right. And the news context for Macy's is less about a sudden turnaround and more about strategic positioning.
They're focusing heavily on the holiday in-store experience and maybe more importantly on supply chain modernization. They just unveiled a new automated fulfillment center.
And the market is clearly anticipating positive Q3 earnings, which are due out in early December. From a value perspective, Macy's looks like a much clearer proposition compared to KSS.
Okay, how so?
Its PE is 12.41, but its forward PE is even lower at 10.73. That low forward multiple suggests analysts expect earnings to actually improve, which makes the stock look cheaper relative to its future profits.
And their financial health seems a lot stronger. They've got a really high gross margin sitting at 40.31%. That's impressive.
It is. It means for every dollar in sales, 40 cents is left over before operating expenses. It signals, much better operational efficiency than Kohl's.
And what about the other metrics?
Their return on equity is also healthier at 11.31%. And critically, their growth outlook is positive. Projected EPS for next year shows a 3.24% gain. That contrast with Kohl's negative projection is a really key differentiator here.
Okay, looking at the technicals, Macy's has delivered some massive performance over the last quarter. A robust 60% gain.
Over 60%, yeah, 60.66%. And like KSS, it's also trading above its 52-week high, showing some serious momentum.
But the RSI is different here.
That's the crucial difference. The RSI 14 is at 68.97. Now, that indicates strong positive momentum, suggesting the trend is continuing, but it is not excessively overbought like Kohl's was.
So for a trader, this looks more like a continuation signal.
Exactly. This makes it a potential buy or hold trigger, based on the idea that the successful recent trend could keep going.
So let's quantify that phenomenal momentum. If we use that 60% gain over the last quarter, we can estimate the price 3 months ago was roughly $13.60.
Right, so a $5,000 hypothetical investment back then would have secured you about 367 shares.
And at the current closing price of $21.85.
Those 367 shares are now valued at about $8,016.
So your hypothetical profit here would be over $3,000, $3,016.95, a 60% return. It really illustrates a successful recovery story, not just a sudden spike like we saw with Kohl's.
Exactly. Which brings us to our final player, Dillard's, DDS. And this one. This is a completely different beast altogether.
Yeah, it's the largest of the group, market cap of over $10 billion, and at $666.61, it's by far the most expensive per share.
And it was up 8.5% on the day, adding over $52 to its share price. A huge dollar move. But the key news driver here is a remarkable show of capital discipline.
You're talking about the special dividend.
The massive special dividend of $30 per share that Dillard's announced on November 20th. That came alongside a strong Q3 earnings beat and impressive comparable store sales growth.
A $30 special dividend. I mean, that's a massive signal. It just screams, we have so much cash, we can give a huge chunk of it right back to our shareholders.
It's the calling card of immense balance sheet strength. And Dillard's also stands out for its ownership structure. It has extremely high insider ownership, 51.55%. The management and family stakeholders are literally the majority shareholders.
So while Dillard's looks pricey on traditional multiples, a PE of over 18, PS of 1.57, the underlying fundamentals seem to justify that premium. You called it a financial fortress.
It really is. I mean, give us the metrics that define that.
Well, their return on equity is stellar. It's nearly 29%. Their profit margin is 8.77%, which is the highest of the three by a long shot.
And the balance sheet.
That's the most critical detail. Their debt-to-equity ratio is minuscule. It's just 0.27. They rely almost entirely on their own generated capital, not borrowed money.
And their quick ratio is 1.00, meaning they have $1 of immediate assets for every $1 of immediate liabilities. They are self-funding and just rock solid.
Okay, but there's a massive disconnect in valuation we have to talk about. The report notes that the average analyst target price for DDS is only $469.33.
Wow.
That's way lower than its current price of over $660.
That's fascinating, isn't it? DDS is trading roughly 40% above what the analyst consensus thinks it's worth. So how do we square that?
Right.
I think the market is clearly valuing DDS based on this tremendous balance sheet strength, the high insider control, and that massive capital return policy. Things that traditional valuation models often struggle to capture fully. The conviction here is just exceptionally high.
So looking at the technical setup, the momentum is strong, but it's controlled. The RSI is at 64.16 strong, but nowhere near being overbought. What's interesting is that DDS is actually still about 9.6% below its 52-week high.
And that difference between the current price and that 52-week high, that becomes the potential buy target or trigger. Given its average true range of nearly $30, this stock has high dollar volatility. A run back toward that high is a very tangible possibility.
Okay, finally, let's quantify that unique advantage Dillard's offers, focusing on that huge special dividend. If you invested $5,000 at that closing price, you would purchase 7 whole shares.
Right, your total investment would be about $4,666.
And the immediate guaranteed cash profit from that special dividend alone, 7 shares times $30.
Is $210.
That's an immediate cash return of about 4.5% on your invested capital, just from the dividend. It doesn't even matter what the stock price does that day. It just speaks volumes.
It really does. So to kind of synthesize these three stories, Kohl's, KSS, is the high beta volatility narrative. It's driven by a short squeeze and an earnings surprise, but it's carrying the lowest profitability and the highest debt.
And Macy's M is positioning itself as the value turnaround play. It has that low forward PE, much better gross margins, and it seems to be successfully improving its efficiency with a clear digital strategy.
And then Dillard's, DDS, just stands alone as the financial fortress. It's a high-conviction, low-debt company with massive insider ownership and a strategy built around these immense capital returns.
You know, we've seen incredible recent performance across the whole sector, but when you look closely at the strategy these retailers are using, a really deep division emerges, especially around real estate.
That's a great point.
Macy's is aggressively pushing digital fulfillment. They're building out these automated distribution centers to modernize their entire supply chain.
Meanwhile, Dillard's is noted for doing the exact opposite. They are going against that modern trend by actively buying shopping malls, doubling down on physical real estate as part of their core strategy.
So as you reflect on all these contrasting metrics and the fundamental strength from the, liquidity crisis at KSS to the fortress balance sheet at DDS, here's the final question to mull over. Which bet on the future of physical retail Macy's focus on digital efficiency, or Dillard's high-conviction bet on owning the real estate in the physical mall is the most compelling path forward for this entire sector?
That decision really hinges on which strategy you believe is going to generate free cash flow 5 years from now. Thanks for joining us for this deep dive. We'll catch you next time.